Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis. Today is Tuesday, December 12, 2017. We're looking at a daily chart of the SPY, or SPDR, which is the proxy for the S&P 500. And we had a couple of interesting things out here today, but all in all, not a lot happened at the end of the day. And we discussed this yesterday in terms of the Federal Reserve, or FOMC, announcement that comes tomorrow afternoon. And then I believe Janet Yellen has her farewell press conference following the FOMC announcement. The Fed is expected to raise the Fed funds rate 25 basis points, or 0.25%. That's what they've telegraphed. We'll see if they follow through. I have no reason to believe they won't, but the market is expecting a 25 basis point interest rate or Fed funds rate increase. So as a result of all that, the market, while it was up earlier in the day, around lunchtime, decided to top out and roll over, and we're basically in a holding pattern similar to a plane that's getting ready to land and it's not ready yet, or there's traffic at the airport, so they put the plane in a holding pattern. Right now, I think the market's in a holding pattern. All the markets, whether it's stocks, bonds, whether it's precious metals, it doesn't matter. We typically have this scenario leading up to a Federal Reserve announcement, which comes tomorrow afternoon, and then you're going to get some gyrations and jockeying for position slightly before the announcement and then following the announcement. So we weren't expecting a lot of market activity today. We talked about that last night, and we really didn't get a lot of market activity today. However, what's interesting, and there are some interesting things out here, at least interesting to me, what you have is a market that closed, or the SPDR closed at 266.78. Well, on the surface, doesn't look that important. Looks like we made a new high today, and we did. But what I find interesting is the high from the 4th of December is 266.80. We closed today at 266.78. Now, that's 2 pennies below the all-time high. They had every opportunity to close the market at a high today, and in the last few minutes of trading, decided not to do it. And here's what I mean. When you look at a 10-minute chart, you can see here the market made a high right around lunchtime, a little bit after lunch, about 12:20 in the afternoon, 12:30 in the afternoon. The market makes a high, puts in a bearish reversal candle on the 10-minute chart, and then basically proceeds to make a bearish wedge or consolidation pattern, rolls over, tries to rally one more time, and rolls over again, and finished right on top of the 10-minute 50-period moving average. And what's interesting is, again, by 2 pennies, they had every opportunity to close the market at an all-time high, didn't do it. I don't know whether that's extremely meaningful or not. I just find it interesting that it didn't happen, and it just so happens that we're 1 day removed from the Federal Reserve, or FOMC, interest rate announcement tomorrow or Wednesday afternoon. So just to wrap up the daily chart of the SPDR, there's really only 2 alternatives. You either close at an all-time high above the high from the 4th of December, and that'll promote more buying activity. And by the way, the volume over the last several sessions wasn't too bad. We've actually had a pickup in volume. As you can see, the average 90-day volume down here at the bottom is 67 million shares and change. Now, the last several sessions, we've been over the average 90-day volume. So that's interesting in and of itself. So volume on the upside while the market's rising is not necessarily the norm. Normally, we have light volume, and it is still somewhat light all in all, but usually we have light volume, and the path of least resistance in light volume is generally higher. But the market's been going higher on a little bit of a pickup in volume. We'll see if that's meaningful or not. But what we have here is a close above the high will be bullish behavior. Okay, or you can look at it as if this is a bearish wedge pattern, so we have a down move, and then we basically have a wedge right up to test the highs. If we don't or are not able to close above these highs, we could have another down move, whether we just go down to retest the recent lows, or we go all the way down to the 260, maybe 261 area. We'll see what happens. This is options expiration week, and tomorrow is also known as Whipsaw Wednesday. So you have Whipsaw Wednesday, quadruple witching options expiration week, and you have an FOMC interest rate announcement coming tomorrow or Wednesday afternoon. So there is a bit of a recipe for some volatility. We certainly haven't seen volatility leading up to the FOMC announcement. However, we could certainly see a pickup in volatility following the FOMC announcement. Here, when we look at the IWM, which as you know is my favorite leading indicator of the market, leading indicator on the upside and the downside, and you can see here that the IWM was down today. So while most of the markets were up, the transports, which we'll get to in a moment, were flat. The broker-dealer and the financial index rallied very, very well today. The SPDR, or the S&P 500, was up 4 points. The SPDR was up, as you just saw. The Dow was up over 100 points. NASDAQ slipped a little bit, down about 12 or 13 points. That's the NASDAQ composite. But when you look at the IWM was down. Now, it is my favorite leading indicator, and I'm curious if the IWM is trying to give us a tip-off. Is this a signal of some trouble in the market over the next few days? We'll find out in short order, but the fact that the IWM is not able to rally with the Dow and the S&P 500 to me is a little bit of a warning sign. And what you have here is you still have this down move, and now all you have is a bearish wedge pattern until and unless you can close above the high of the second breakdown candle here. So the candle from the 5th of December, that has a high of 152.96. If you can't close above that level, then this is most likely trying to or wanting to head lower in the IWM. How much lower? Probably not a ton, but the pressure right now in the IWM is to the downside. From my vantage point, the IWM is signaling there are some lower prices ahead, and it's not necessarily clear sailing. And I think the FOMC announcement and the fact that this is quadruple witching options expiration, we may see some volatility and some more downside in this market yet. I don't think they're finished on the downside. The transports were basically flat today. They're down about 3 points, but that's essentially a rounding error in the transports, and the story remains the same. I think they're just eating some time off the clock, letting home base or the 20-period moving average come back up to price, go sideways. Maybe they dip down a little bit if the major markets sell off a little bit. You can certainly see some downside in the transports. And at some point in time, the 20-period moving average and price will get close enough to where the market will have reset itself and it will be poised to move higher at that point. The longer term picture is we still are in a bullish uptrend in the transports, and for the most part, all the markets for that matter. We're going to talk briefly about the XBD, or the broker-dealer index today, and the same thing goes for the XLF. And if we just look at the XLF, you see much of the same chart. These financial indices were on a tear today, so the financial sector was on a tear today, and obviously it's getting extended still yet, overextended, away from home base, away from the 20-period moving average. So at some point in time, this will correct a little bit, or at least go sideways and let the 20-period moving average or home base come up into price. But the point that I want to make is, even if we do get a dip in the markets, it's not going to be a big dip. And the reason why I say that is because without the financials, the market is unlikely to have any kind of a big decline. You have to have participation from the financials on the downside if the market's going to decline. And you also have to have participation in the financials if the market's going to rally. Right now, the financials are telling you there's nothing wrong with the market. And the likely scenario is, even if we have a dip due to options expiration and the Fed and all that stuff, the reality is we're still in a bull market, and ultimately there are higher prices coming in this market. That's what the financials are telling us right here today. Taking a look over at the gold market, you can see here that while gold didn't necessarily finish down much on the day, we did take another dip down, and we're getting closer to my level of 1,229.30. Give or take $1 on either side, a couple of dollars on either side. It's not really that important. What the point is that we're getting close, and anywhere in that zone, when you get into the 1230s, and I think we might have even gotten there today, the low today happened to be 1238 spot 30. So we're getting into the zone where we were within at Lowe's today, within $10 of my target price. It didn't hit my target. I would like it to hit my target and see a reversal. We didn't get any kind of a reversal signal today. No high volume reversal, nothing that I can hang my hat on, but we certainly are getting closer. And tomorrow, with the FOMC announcement, may be the ticket to get one final flush down in the gold market and silver for that matter. And maybe they hit the target and put in a reversal candle. And that would be an area where we have something to trade against because we know where we're wrong. We would have a low to trade against in the metal markets. So right here, right now, I'm not ready to jump in just yet. We're close. We didn't quite get to my number yet, but the plan is coming together. As soon as we got below the 200 period moving average here that we consolidated above for quite some time, looked like we were going to break out a number of times, never happened. As soon as we closed below the 200 period moving average, that was all she wrote. And here we are down in the 1230s today. Much of the same routine in silver. Didn't quite get to the 1550. Maybe this is a low, maybe it's not. We're close. But I think tomorrow, with the Fed announcement once again for the 100th time, I think that's when you're going to get some gyration around all the markets, metals included, and maybe we get that one final push down into my levels in gold and silver. Nothing doing, no signal, no high volume today, nothing that tells me that we found a bottom in silver, and same goes for gold. Crude oil was down a little bit today, but, down 48 cents, 47 cents as we speak now. Not a big deal one way or the other. We're still above the 20-period moving average. We tested it. We tested yesterday's lows, snapped back a little bit. We closed yesterday above this red candle high from the 6th. That's important. Maybe we just go sideways for a few days, build some energy for another push higher. But again, you can also see that the crude oil market might have some swings around that Fed announcement as well. So all markets are susceptible to gyrations tomorrow afternoon. So not a lot you can do with that. It's still in a bullish uptrend. There's nothing wrong with the crude oil market. Really, the only trouble that would occur, in my opinion, would be if we closed below the low from the 7th of December. That's 55.82. As long as we stay above that level, it's really still in a bullish formation. And specifically, if we stay where we are above all the moving averages, in particular the 20 that we did test today and closed, or we are back above, we'll see where the official close is. As long as we're above all the moving averages, this is still in a bullish uptrend and in the most bullish position it can be in. The bond market, you'll get another market where we'll get some gyration tomorrow around the FOMC announcement. We took a dip down, tested the 50-period moving average. No big deal one way or the other. Finished a little bit down on the day, or are down currently on the day. But for the most part, there's nothing wrong with this bond chart. Nothing has changed whatsoever. All we're doing is trying to get through this area here. Again, one last time, I think this day here where we did close above that level is the ultimate tip-off. Now tomorrow we can get either direction. We can get a flush down in the bond market on the FOMC announcement, or we can get a spike higher on the announcement tomorrow in the afternoon after the FOMC announcement. So anything goes. It's kind of like a crapshoot or an earnings announcement where you don't really want to own a stock into an earnings announcement. You really have no idea which way it's going to go. Anything can happen, and it's more of a roll of the dice or a gamble. So the same thing goes for most of the markets leading up into an FOMC announcement. Now, I will tell you, of late, the last several times, for the most part, they've been relatively quiet around the announcement. We get a little bit of back and forth activity, and then the market settles out and it's like nothing happened. And part of that reason is because the Federal Reserve has made a habit out of telegraphing exactly what they're going to do. So there once was a time years ago when every time the Fed met, they would at least surprise the market sometimes, whether it's an interest rate increase or a decrease or whatever they would say in their prepared statement. They would, or at least the market would act surprised a lot of the time. The market would anticipate the Federal Reserve announcement, and then there would be some element of surprise. And over the last several years, that's gotten tamped down quite a bit from what it used to be. So we'll see what happens tomorrow and if there's some gyration in and around that announcement at about 2 o'clock p.m. Eastern Standard Time. So here's the dollar, and what I want to point out, and I had made the video yesterday before the official close of the day in the dollar. So watch this. So yesterday when I made the video, the dollar was trading above, I believe, if I'm not mistaken, above the 93.495 level. That's an important level to close above. Now, we did not close above it on the 8th. So basically, we're above that level right now, and we'll see where the close happens today. It's important if we close above the red candle high here, 93.495. But again, same thing goes for the dollar. As with all the other markets, you'll get some movement tomorrow afternoon one way or the other. So anything that happens before then could be negated based on whatever the Fed does or doesn't do or says or doesn't say. So we'll just wait until tomorrow, and I think the markets will shake out after the Fed announcement, and we'll go on from there. So with that, it's everything that I wanted to and intended to discuss tonight, so I'll give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.